If there's one retail stock that has been hit very hard recently, it's of course Dollar General. Used to be a fantastic compounder up to $250 per share. Now we're down to $81 per share. Of course, when situations like these happens, it's always maybe an opportunity to buy. Especially with a stock being at levels that we haven't seen since 2015. And since then, revenues have around doubled. But Dollar General is not a stock like Walmart or Costco. Walmart and Costco depend on how well the American consumer is doing. Well, for Costco, it's more like how many people sign up for your membership. But Dollar General is different. Dollar General doesn't have their big stores everywhere. Dollar General doesn't need, like Walmart, to get all those people in who spend all the money there. Dollar General is for the poor people. They are in areas where there's no choice but to go to Dollar General. There is no other store. There is no Walmart where you can buy your produce. And that is also where a lot of our issues come from. Currently, the only growth is the consumer category. So that is basically what you need to survive. The other stuff at Dollar General is shrinking. This pattern suggests that our customers are less able to stretch their budget through the end of a month. 60% of their sales come from households earning less than $35,000 annually. Meanwhile, the average Costco shopper has $60,000 in income. One person. So in total, the household income around $120,000. That is 4 times as much as Dollar General. So when these people get squeezed, they're not gonna spend any more than they can absolutely afford. And that is also why revenue growth is down so much. You had your huge boom in income. Why? Everyone got their money sent to them from the government. Even if you never had any money in your life, you now could go to Dollar General and at least buy something nice for you for once. Maybe you're buying your kids new clothes. The other ones already had holes in them. Or maybe you're just switching to the brand for once. You're getting the nice soap instead of a $1 Dollar General soap. Well, this is the explosive revenue growth ad. But now, revenue growth has been flat. Plus, they also had one other big issue. They had built up a huge amount of inventory until 2022. Now they have started to reduce that, and I like that. While they're still growing a tiny bit, the inventory is staying flat since many years. Less money in inventory means more free cash flow that they can use for the business and the shareholders. And operating cash flow is already back into growth mode. Free cash flow has not really recovered that well, because currently Dollar General is on a spending spree. They're really improving their stores, building new ones. Now they have already had kind of a peak there. They expect capital expenditures to be on the max 1.4 billion this year. That is way below the high that they had in 2023. So that is going to be another boost to the free cash flow. This company is currently coming out of an investment phase. And if we're gonna they make around 3.3 billion currently in operating cash flow, minus 1.4, that is 1.9 billion in free cash flow. That is less than a 10 times multiple to the market cap. And this is what makes this company so interesting for me. Because yes, they can't control the weakness they have right now, which is their consumer base, but that is eventually gonna shift. And with them having renovated that many stores, grown so much recently, I think they can go back to those 5 to 8% revenue growth. And they bought back a lot of shares back then, 4 to 5%. And that was during times where the stock was way higher. So I think currently they could buy back a lot of shares. With a free cash flow yield of currently 9.4%, not even 3% is going out for the dividend. The other 6% could be turned into buybacks. Now, if you look at the total debt of the company, yes, it shows they have a lot of debt, but they only have 6.2 billion of real debt. The rest is long-term leases. And them growing kind of just shows that they're expanding a lot. With them stopping the buybacks recently, of course, cash on hand has exploded. In 1 quarter, it has grown by 500 million. Now, this is not a safe bet, not at all. This is not a Costco, this is not a Walmart, but it is still a defensive stock. Now that we're coming out of a high inflationary environment, slowly the income of these people is gonna grow. Then I think Dollar General might have a chance again. So let's see, what would I currently pay for the stock? Earlier we said we would get to around $1.9 billion in free cash flow at the moment. If we take the current share amount, we would get to around $8.6 in free cash flow per share. Let's be safe, let's say 8. What is Dollar General gonna grow at? Yes, they're coming out of an investment phase, which means they're gonna have a higher increase in free cash flow than before. They opened a lot of stores, they're slowly stopping the problem of shrinkage, their inventory is being lowered, but of course, we don't know when their consumer base is gonna recover. So I'm just gonna say for the next 5 years, 6% free cash flow growth. That involves maybe 2% in buybacks, 4% in normal growth. Yes, they've grown at 10% historically, but they're currently having difficult times. I want to be conservative here. I want to have a safe investment. Afterwards, we're going to ramp up the buyback program. If they have really only bought back so little shares for all these years, that means we're going to have a lot of cash. 14 multiple, 35% payout ratio with a little reduction due to taxes would give us $103 as an intrinsic value per share. Currently trading at 81. 27% discount, so already not bad. Now, what if it goes even better? we basically go back to 8% revenue growth, 2% buybacks. Afterwards, we're gonna up the buyback program even more, and the 17 multiple because you know the company is growing faster. Well then it would be a great buy. That would basically be a double just for it to go to the intrinsic value of a 10% return. But it can also go worse. Customer base just doesn't recover. They're slowly gonna get squeezed by competition from the outside. 3% growth over the next 5 years, 6% after that. 10 multiple because it's just a horrible company at that point. Well, we wouldn't be too much below the current value. Where do I see Dollar General right now? It's a difficult story. I don't see it at the moment as something I'm gonna add to my portfolio. It is not a very high quality company. It's an okay company. It has its moat that it is positioned in these areas where it doesn't make sense for other retailers to go, but it has the issues with its consumer base. At the right price, I'm probably gonna be willing to buy it. I think these numbers make sense to me, but I have other buys which give me lower risk for a higher discount right now. So if it falls even lower, let's say it falls to $70, then I'm probably gonna add it up. I'm gonna put a price alarm at $70. What do you think? Write it down below. Have a good day.